This is 22 News in Focus.
Good Sunday afternoon and welcome to 22 News in Focus. I'm Laura Hutchinson. April is Financial Literacy Month. People are always looking for ways to stretch their dollars, whether by cutting expenses or getting their money to work for them. And that's where 22 News in Focus comes in today. Today we'll be talking about the best way to organize your finances. Build that savings account now and put enough money away for retirement. We'll also be talking about this week's deadline for filing your taxes if you haven't already, and what you could do to be better prepared for next year and avoid falling victim to identity theft. We have a lot to get to today, but joining us first to talk about your personal finances, we have John Zalicki from Cambridge Credit Counseling. Thank you so much for being here. I appreciate it.
Thanks for having me.
So talk to me about Financial Literacy Month. First of all, why is it so important to have a month where we reevaluate our finances?
Just a good time to really sit down with your budget, your money coming in, going out, assets, liabilities, really examine your whole portfolio and set some goals and for the year and really work to have a successful year and build up savings and all the things that you want to do in the upcoming year.
So I think that we last had you on around New Year's when everybody was setting their New Year's resolutions. So now by April we've all dumped that already and we're back to our old habits. Maybe not, but so let's talk about what some people would like to accomplish. And one of those big things is credit cards. Let's talk about budgeting and saving in our next segment. But right now I really want to talk about credit cards. First of all, how many credit cards is too many for one person? Let's first start there.
It can vary depending on the situation in the household. Credit cards can be good if they're paid off quick. It's good to have a card for emergencies, travel, and business in some cases. A gas card with points is a new thing. Building up miles on a card can be a good thing. So it's all about where you're at financially and what you can afford to pay off quick. But a good rule of thumb is 2-3 cards. Department store cards typically aren't the best cards to have unless you're paying them off every month, because those are typically the higher interest cards. So I guess the quick answer to that is 2 or 3, but it can vary from household to household, really depending on your financial situation at the present time.
Okay, so you were saying paying them off quick. What does quick mean? I guess to one person, could that mean paying it off that month, and maybe to another, within 2 months or 3 months? What is a good, reasonable expectation to be able to pay off your credit cards?
Again, it depends on the interest rate on the card. If you have a 0% card, the urgency is not as great as if you have a 20% card. So it's really examining each card and the rate and the benefits that come with the card. If you're paying interest on a card, you want to pay it off as quick as possible, obviously. Within, obviously, perfect scenario is a month, but 2-3 months at most. If you're finding that you're not able to pay the cards off within a couple months, that usually means there's a problem somewhere, and you want to examine, why it's taking longer to pay off the card. But again, varies from household to household, and quicker the better, of course.
Okay, so you bring up a good point, these different interest rates. When you're looking at your credit cards and you're figuring that you need to get these paid down now, where do you begin? Do you start with the one with the highest interest rate, or do you start with the one maybe with the lowest balance to get rid of that? I guess, what would you recommend?
There's a lot of different strategies out there. Some experts say pay the smaller one off first and kind of snowball to the bigger ones. We believe, and I believe, the higher interest cards are the most important priority to pay off. The smaller ones, the strategy behind that is that psychological gain. You're paying off a card, it's done, then you move to the next one and the next one. But financially, the smartest way to do it is to focus on the one charging the highest finance charge, the most interest, and then work your way down from that. You won't see the gain as quick, like getting rid of a card, but financially, it's always good to focus on the highest interest card charging the highest finance charges.
Okay, and when you're focusing on these, I know that you want to put as much money toward a credit card as possible, but what is the best amount to put toward if it's not the minimum? Because I know that you're going to say paying the minimum is not a good idea because you'll almost never pay it off. So what is the best method? Is there a strategy to finally get those cards to come down in balance?
You want to pay as much as you can, of course. If you can double the minimum payment, that's great. But if you find yourself in that trap where you're not able to pay it off within that 2 to 3 months, you really want to allocate as much as you can towards the cards. Again, focusing on the higher interest card first. You want to also pay attention to your savings. You want to allocate some money for savings. Putting all your money towards your debt and having no savings means you're going to fall back into the credit card trap if you have an unexpected expense or emergency. So allocating a certain percentage for savings, again, varies from household to household. You want to try to put in 10% if you can into your savings, and then allocate whatever you have extra towards the highest interest card. So there's no set percentage, but if you can double the minimum, that's obviously helpful, or even above and beyond that if you can afford to do that.
Okay, and speaking of savings, so when do you finally take a big chunk of your savings and put it on a credit card just to get these down? How do you sort of evaluate what's more important, to have that significant cushion in your savings account or to get your credit down? When do you just take some of that savings to get rid of a credit card, or at least get it to a manageable level?
Absolutely. Again, a lot of experts will disagree. Some experts say less savings, get rid of that debt. It comes back to the interest rates. If you have a 0% card for 18 months, keep that money in savings to have for emergencies. If you're paying 20%, you may want to take some of the savings to put towards the debt to knock it down. But most experts say you should have at least 3 to 6 months worth of your expenses in savings before you start putting a good chunk to your credit card debt. So if you total your expenses and they add up to $2,000 a month, let's say, you want to have at least $5,000 to $6,000 in your savings before you really attack the credit card debt. Not everyone follows that. Some people would rather just pay the debt down and live paycheck to paycheck, but if you really want to do it the right way to avoid further credit card use, you really want to have that savings in there so that if something happens, the car breaks down, you can just use your debit card, pay $500 and not have to worry about accruing more credit card debt.
Okay, credit cards can obviously be scary because we're talking about debt and getting trapped in some of these loops, but they are very important for helping your credit score. So let's talk about some things that can help your credit score out. As we've been talking about paying off credit cards, I've heard that sometimes it's good to leave a card open so that you have you actually have open credit. So what do you recommend? How much open credit do you want to have? What would you recommend to people?
You want to have as much available open credit as you can, and you're allowed to. Part of your credit score, and a big part of it, is having that unused available open credit and that you're not using it or you're paying it down every month. So once you get close to your credit limits, that puts a strain on your credit score. The FICO scoring system, right around 30%, will put a mark on your credit. If your limit's 10,000, you start getting to 3,000 or 4,000, and you get over that 30%, that's where you'll actually see a strain. So you want to try to keep it below 30% of your credit lines. Again, easier said than done, but if you can, you want to work to do that, and just keeping open credit lines with minimal use. Closing a card can impact your score for different reasons. You lose that available credit, and then once that card is closed in 7 years, that will fall off your credit, whereas if you keep it open, that positive payment history will stay forever until you close that card. So ideally, yes, you want to keep these cards open and just use them minimally, use them as minimal as possible.
So is it possible to have too many credit cards or too much open credit, though? I feel like we're always walking this very fine line. So is there such a thing as too much, and you want to limit how many cards you actually open?
Well, opening cards can affect your score negatively if you have inquiries and opening them. If they are open and they're extending you these lines of credit and you're not using them, there's really no negative to your credit in that regard, as long as you're not, again, approaching that 30% line. So it's about discipline too, though. Some people, if they have all these available credit lines, they're going to go out and use some of them. So if you can be disciplined and leave them low or zero, and not paying annual fees or different things that can take money out of your pocket, it's really not a bad thing at all.
Okay, and how often should you check your credit score?
The new thing now, a lot of credit card companies are putting it on your statements. So I know Discover, I believe, does. Capital One, I think, does. So a lot of credit cards are giving you your credit report or credit score every month. You can go to creditkarma.com and get your score every month for free, along with a credit report card. So those sites that promote the score for a fee are kind of becoming a thing of the past. So there are ways to get your score for free. And if it's free, you can check it every month if you want. It's not going to hurt anything. and even pulling your credit report with through annualcreditreport.com once a year for free is encouraged. You pulling your report or a soft inquiry on your report has no bearing on your score. The only time it affects your score is if you're applying for financing, and those types of credit report pulls will affect your score. But as long as it's a soft inquiry or the Credit Karma or on your credit card statement, you're fine. Check it as often as you can.
Okay, and for people who are hoping to, be buying a car or a home, I guess what score are you aiming for? What's a good number?
You want to be over 700. The median score is in the low 700s. The closer you can get to 800, obviously the better. But usually if you're over 750, you shouldn't have a problem, getting, most financing. But, obviously the higher you can get, the better.
Okay, very good. I know a lot of people have credit cards, so that's some good information. But more people want to know about saving and budgeting and just managing a healthy financial lifestyle. So we'll talk about that in just a little bit. Stay with us. You're watching 22 News in Focus. Welcome back to 22 News in Focus. April is Financial Literacy Month, and today we're talking about everything from credit cards and savings accounts to retirement funds. It's also the last week to file your taxes, so we'll have a tax preparer on with us to talk about what you need to do now and what you can do all year to get your best refund, and what you can do if you get audited. But first, we're continuing our conversation now with John Zalicki from Cambridge Credit Counseling. Thank you so much again for being here. We were just talking all about credit cards and answering all of our credit questions. Let's now talk about savings and budgeting. How do people begin to set a budget? Somebody who doesn't have a budget, what do you do first?
First thing you want to do is track your spending. You want to basically keep track of every dollar you spend for a minimum of 30 days. You want to go 30, 60, 90 days, but start with 30 days. Keep track of every dollar that goes out. Obviously, you want to journalize your income that's coming in and do a comparison of your net income, what you're taking home to go towards your bills, versus what you have going out. Most people, until they track their spending, don't really know exactly where every dollar is going. So every day, just keep track of the morning coffee, having lunch out, dinner, whatever it might be, and then at the end of the month, go back and review that. And most people are very surprised on where their money is going. That $5 coffee every day turns into a couple $100, a month, or $100 a month, and you get lunch out. So it adds up pretty quick. So start by doing that, and then review the budget. Identify areas you can cut back on. Is this a necessity, or is this something I can do without? If things are tight, you want to try to eliminate as much overspending as possible, and that money can go towards a credit card debt or building up a savings. So, but I'll definitely start by tracking everything.
Okay, and although some people may find that coffee to be a necessity, I think. Now, what do you suggest people do with their paychecks? Is it good to have it come to you and physically deal with the cash and put it in different places for different bills, or is direct deposit the best way to electronically track all of this?
Most people say, and I would say direct deposit, have it in the bank account, whereas cashing a check can lead to different problems. If you have it in your bank account and you're tracking it, what's going out very carefully, then I would encourage people just to have it set up and get right into their checking or savings account.
Okay, so how do you begin to build a savings account? We just spent a long time talking about our credit cards. How do you start to divvy what goes onto your credit cards and what goes into your savings account?
Goes back to before, household to household, it can vary, but you want to try to get to that 3-month mark. And so if you do your tracking of your spending and your budgeting, and your monthly expenses are, again, that $2,000 amount, you really want to focus on getting to that 3-month minimal. And most people out there will say that's almost impossible to do. But you got to start small. Even if you just save $100 a month, or $50 a week, whatever it might be. It's not going to happen overnight, but you start small, work on building up that savings. And again, most people feel that having that money in savings is important in the future, so you don't have to use credit cards. And it's good to go to bed at night knowing, okay, I have a couple thousand in my checking account, so no matter what happens tomorrow, I'm covered. I don't have to use a credit card or worry about borrowing from someone So that peace of mind that comes with a savings account is important.
Is there a percentage of a paycheck that you recommend people put into savings? I'm sure people will come to you and say, all I can manage to save is $5, and then you look at what they're spending and see that they might be able to save a little bit more by cutting back some of these things. So realistically, what should someone be able to save? Is it a percentage of their paycheck? I mean, obviously not knowing all the expenses that people have, but
right.
For a family, or somebody just starting out, I guess, what's their starting block? What is that percentage that you want to at least aim for?
I mean, I would say 10%. If they can. Some people can only do 5, some people could probably do 20. So once they track their spending and identify areas they can cut back on, then they can kind of create a set percentage. But I guess if I had to throw out a general percentage, the goal would be 10%, to try to just put it right into savings, pretend that money's not even there. Just put it in there and then leave it alone. And again, if it's an emergency, obviously you can go in and get it, but you want to pretty much treat it like it's not available. And try to take it right off the top. As soon as you get paid, some employers, you can have it taken right out of your paycheck into a different account. Some banks will let you transfer it to a different account. So try to keep it away from your everyday checking and just build up that emergency account that way. And again, some families can maybe start, larger than others, but even if it's $5 a week, if that person, it's all they can save, within a few months they'll have a couple $100 hopefully in there and they can work. But again, you got to realize it's not going to happen overnight, and you got to start small.
Sure. And what about holidays and vacations? That could usually be the budget killer because you have something very expensive that you maybe know is coming, but you don't set money aside for. So, how do you sort of manage to still continue to do those vacations and buy people gifts for Christmas around that time, the holidays? So how do you recommend that people manage that all year? We're in April. How can you prepare for that now?
Right. Most people have an idea what they're going to spend at the holidays. So if you know you're going to spend $500, you put $10 a week away starting January. If you start now, it might be a little bit more, obviously, but start by putting $15, $20 a week away in a separate account, and that's for holidays. That's a good way to not have it just come all at you all at once. Because if you wait till the last minute and then you need $500 or $1,000 and you don't have it, then you're using a credit card or something else is going without. So again, just starting out early, planning ahead, and realizing that, again, that $10 a week, that doesn't seem like a lot, will add up over a year's time, and you kind of cover it that way.
We're going to talk to somebody in a little bit about when to start saving for retirement, but as far as learning how to save in general, do you find that parents talk to their kids at a young enough age about this? How young is old enough, I guess, to begin saving and learning how to save?
Yeah, I mean, you can start very young with them and let them know that, they need to be prepared and, savings accounts are important. But yeah, I did an article a few weeks ago on a magazine with children. I said the earlier the better. The soonest you feel that they're, ready to have that talk, it's important to talk to them and let them know that, money doesn't grow on trees. They got to start, the money they get, they have to value, and they have to save it, and they can't just go out and spend it. And credit cards, especially when they get to be 18, they're going to get credit card offers most likely. They got to realize the importance of understanding how a credit card works. But absolutely, I don't think that's out there enough where parents really sit down with their children and explain, this is really important things you need to know for your future success.
Do you see any financial mistakes happening young that are difficult to dig out of? I guess for Financial Literacy Month, what are the best mistakes that people can avoid, whether you're adults, a teenager, what are some of those mistakes that you can avoid making now?
Overspending, going out and buying things you don't need, non-necessity items, charging them, and just not having that plan. It's all about planning. Just set your goals, make realistic goals so that if you can, there's a good chance you can hit them. If you don't hit your goals, restructure it so that you can improve and make adjustments, and be patient. And realize, again, it's not going to happen overnight.
Yep. Pay attention to those statements and see where you're really spending.
Absolutely.
All right. John Zalicki, Cambridge Credit Counseling, thank you so much for talking to us. I really appreciate it. Some great information. And it's not just about your savings accounts you need to contribute to. It's also your retirement funds. We'll get to that after this. Stay with us. You're watching 22 News in Focus. You're watching 22 News in Focus. April is Financial Literacy Month, which is why we've dedicated today's program to improving your finances. We spent the first part of today's program talking about credit cards and how much debt is too much and what you can do to effectively pay it down. We also talked about budgeting and saving. In just a little bit, we'll talk about this last week of tax filing season and what you can do to get your taxes done on time. Before we get to that, let's talk more about saving money. This time we're not talking about a rainy day savings account. We're talking about the money that you'll need to live on later in life. And joining us to talk about preparing for retirement, we have Mark Teed with Raymond James Financial. Thank you so much for being here.
Hi, Hutch.
Hi. Call me Hutch. Go for it. So we were just talking about the savings account, and a lot of people really try to walk that fine line of savings and retirement and paying off your credit cards, as we were saying. So first off, what is the ideal amount to save for retirement before you call it quits?
The amount or the percentage?
Amount, percentage, what do you have?
Well,
People really don't know what to do.
I think if you really start out thinking you're going to save percentage-wise, I think what John said, 10% is probably the minimum. Most people will tell you they can't do that, so they want to start out much lower and try and work their way up. That's fine too. But I think the ultimate goal is probably 10, 15, or even 20% of your income every year committed to saving for your retirement.
Okay, so when people do look at what they have, then what is a good sum to have in your retirement accounts before you feel like you can live off of that? Say if you're at 65 and want to retire.
Well, I think $1 million is probably a good sum, because if you look at taking 4%, which is the generally accepted amount that you can pull from a principal without really invading principal, that's $40,000 a year. So whatever you're making, that's a guideline. So probably $1 million at the minimum is what you should have when you retire.
Okay, and that's good to retire at 65, later, earlier?
Well, I think retirement, they've repealed the retirement age in America, so I think people are going to probably continue to work until they can't work anymore. So I think 70, 75 might become the norm at some point.
Okay, so when we're talking about retirement, we hear a whole number of different terms. We hear about Roth IRAs, 401ks, all different types of accounts. I guess, how do you find out what is best for you? What is the difference between these accounts too?
Well, if you work for a company, generally they offer some sort of retirement plan. In most cases, it's a 401k plan. I would do that first, because there's usually tax benefits, there's a matching contribution, and there's all kinds of reasons to do it for long-term planning reasons. But if that's not available through your company, you might want to consider an individual IRA or a Roth IRA. If you don't need the current tax benefits, I strongly would recommend a Roth IRA, because even though you don't get a tax deduction currently, when you finally do retire, all that money is in an account, and the Roth becomes tax-free. So as you pull money out when you retire, 65, 70, 75, all that money comes out tax-free. All the money you put in, plus all the earnings that you've accrued.
Okay.
It's fabulous.
So now we were talking earlier about managing your credit debt and balancing the savings and all of that. What if you do find yourself in a situation where you need money and you do have these retirement accounts? Do you ever recommend pulling from that? And can you pull from a Roth IRA? And can you pull from, how does that work?
Well, from a traditional IRA or 401k plan, you can borrow against your plan. I don't recommend it unless you, but it's easy to say. When people need money, they really need to get it from any source. So if you do need to borrow it, you have to pay it back in a 401k over the next 5 years. A Roth IRA, you can actually pull money out if it's been in there a number of years. 5 years, I think, is the minimum. But you can pull out, before that, your principal. So sometimes people will use a Roth almost as a savings account. Your next guest will talk about the taxation of Roths, but I would say if you put money into a Roth, an IRA, a simple IRA, any kind of IRA, keep it in there until you retire.
Okay. One thing that people really struggle with is giving their kids everything. You know, you want your kids to go to college, you want to take vacations with your kids. How do you balance that and also taking care of yourself as well, managing your own future? What do you say to people who come to you about that?
Well, there's an old saying, and it's pay yourself first. And that means take and put money aside for your college funding and for your future retirement, and then live on whatever's left over. In some cases, that might be only 60% of what you take home, because you need to save that amount of money. Whatever it is, Pay yourself first, both your retirement and your college funding for your kids, and then live on everything after that, and you'll be fine.
Okay. How early do you start planning for retirement? For people who have kids who maybe aren't watching this program, but they need to go talk to them, how early?
I think the day you sign for a new job, you ask him what the health benefits are. The next thing you ask is, where do I sign for the 401k plan? You should start immediately, because just the time value of money over a long period of time. I did a little calculation before I came and said, if you put $1 in every month for 41 years, you start at 21, you retire at 65, that dollar turns into $5,000. If you could do $100, that $100 a month turns into $500,000. So these become very big numbers if you have the time, the patience, and you invest properly.
Okay. You were saying for some employers that don't offer 401ks, there's still options out there for you. How do you get started? How do you find that account?
If you don't have a retirement plan through an employer, you could talk to someone like me. You could talk to someone like a local bank. We all have traditional IRAs that we can set up, and we highly encourage people to do that because there's a lot of tax benefits to setting up an IRA. So you really have to do a little bit of homework. Just go to Google and type in IRAs and where to find them, and you'll get plenty of answers. But most everybody offers it. Really, it's not who offers it. Really, the hard part is the commitment to doing it on a consistent, persistent basis until you retire.
Okay, now some people may be considering, should I get into the stock market and start investing my money that way? Who is best to do that?
Well, because I'm a stockbroker, I think everybody should be in the stock market.
Okay.
And the younger you are, the more risk you should be taking because you can recover more. Because the more risk you take, usually the higher the returns. History bears that out. So if you look at the long-term stock market, smaller companies, more aggressive companies, generally earn about 12% a year. Government bonds earn $4 and $5. Over 4 and 5% over a long period of time. So the more risk you take, the more money you'll have at the end. So when you're younger and you can afford to lose it, take the risk.
Okay, what questions should you be asking when you go and talk to someone like yourself? How can you go in feeling prepared for this, knowing that your money is going to be protected? Say you don't know a whole lot about the stock market. So what kind of questions can you go in asking that would benefit yourself so that you know that you're getting the best, putting it in the right place?
Yeah, that's a great question. The hardest part is to have the trust in the future, because it's easy for me to say what I think the markets are going to do. I really don't know. We just know based on history how they do perform. So I would ask for some evidence of how markets have performed during different times, different periods, and see if you're comfortable with it. Because I once had a customer that called and said, that stock you just sold me, I just can't sleep at night. And realized, and it was a big company, but the fellow was very uncomfortable with it, and we modified it. So I think you also have to know what you're comfortable with, what kinds of risk you're willing to take, because if it's too much risk, you won't be able to sleep and you'll be very uncomfortable about it. If it's if there's not enough risk and it's too easy, then you're not taking enough risk. So it has to be slightly uncomfortable, but not so uncomfortable that you can't sleep at night.
That you make a good point. And so how easy is it for you to go in and reverse some of these decisions that you make, or change them or tweak them?
Well, everything that we deal with is very liquid, so it's easy to make a change. As long as the goals don't change, we can change the plan periodically. But really the goal is to set a number down the road that you're comfortable with, that you think you're going to need, and just stick to it. The hardest part is the sticking to it and making sure that you keep doing it.
Okay. We were talking about how early you can start saving. What about somebody who's starting very late? Is it ever too late to sort of get in the game and still have something for yourself? Say this isn't something you thought about.
Yeah, no, it's never too late.
Okay.
It's never too late. But every month, every year that you wait, you have to fund that much more to get to your goal. And if the goal is 7 figures, that sounds like an awful lot of money. But in today's dollars, 30 years from now, that might not be that much money. But I think the longer you wait to do it, it's like procrastination. It really hurts you. So you really need to do it now.
Have to get in the game.
Like today, I would actually pick up the phone today if you haven't funded it and call somebody or go online and find something, because it's really that important, Laura.
Very good. Mark Teed, Raymond James Financial, thank you so much for coming on and talking to us. Some great information.
Thank you, Laura.
I'm sure you're inspiring people to start saving for retirement. Thank you. And you only have a few more days to file your taxes. We'll talk to a tax preparer about getting them done on time and what you can do if you get audit. That's still ahead. Stay with us. You're watching 22 News in Focus. Welcome back to 22 News in Focus. It's your money, and today we're talking about ways to stretch your dollar farther. We spent the first part of today's program talking about the savings and retirement accounts and what you can do to protect yourself financially. Speaking of protecting yourself financially, you only have a couple more days to file your taxes, and that brings us to our next guest today. Joining us, we have Andy Flaherty, an H&R Block tax specialist. Thank you so much for being here.
Thanks for having me.
As nice as you are, some people really put off coming to see you.
Oh, is that right? They really do, and some of that is fear, thinking they may have a tax obligation or anything like that. But,
True.
There's only a few days left to file, so what I would do is encourage everybody to gather their information and start the process. Give us a call at one of our offices and come on in.
Okay, so let's talk about this. Is it too late to get your your taxes filed on time if you do it today or tomorrow? You start
Absolutely
gathering
not.
stuff?
You've got until April 15th to file, and if under certain circumstances you may not be able to gather all your information, you could file an extension, although most people really don't need to file an extension. The best thing to do is put together your W-2s, your health insurance information, any other type of income or investment things you have going on, bring them into our offices, and we'll get right going on it.
And we'll get it happening.
Exactly.
So let's talk about that extension that you mentioned.
Right.
Who would be eligible, or who would need to consider filing an extension?
Well, if for one reason or another you didn't have the information you needed to properly file, like say you lost your W-2 or your employer didn't issue you a W-2, or you have investments that may issue you a K-1, you're part of a partnership, a lot of those things don't come out in a timely fashion. So if you're missing a key piece of information that you need to document an income or expense, then it may make sense for you to file an extension to file. I can tell you, I encourage everybody to file something on time because the penalties for not filing can be significant. We're talking about, a 5% penalty per month for not filing or filing an extension on time by April 15th.
Wow.
So, that could add up. So you had $1,000 tax liability, 5% a month of that adds up really fast.
That does add up fast.
Yeah.
So would you find that the people who haven't filed their taxes yet generally owe at this point, or do you really see a whole range?
It could be a whole range. I think a lot of the reasons that people don't file timely is they think they might owe. But until you actually do the math and figure it out, it could work out either way. You may have a tax obligation, or you may be expecting a refund.
So yeah, go ahead.
So what I was saying is, come in, prepare your taxes, and if it turns out you have a tax obligation, there are methods you can do to make arrangements to pay that.
Okay, and if you do file an extension, does that mean that you get to put off paying the government if you do owe?
Unfortunately, no. What we tell people is when you file an extension, the expectation is that you'll pay 90% of your tax obligation at that time, right? So the question is, what happens if I don't pay on time or I can't pay in time? The government charges you 0.5% a month penalty for not paying in a timely basis, up to say 25% of your tax obligation. So the best thing to do is file your taxes on time, pay 90% of what you owe. If you need to file an extension, pay the 90% of what your expected tax obligation is, then you shouldn't have any problems. If you file on time and you owe money and you don't have the ability to pay, you can always make arrangements to pay the government. You could get a temporary extension to pay. I believe they'll give you 121 additional days to pay, or you can make some type of payment agreement with them.
How can you find out what your obligation would be? Is that just as simple as looking at what you paid last year, or is there more to it?
Actually, you just prepare your return. Right? You prepare your return without the missing information. That's going to give you a figure of what you owe, and that's what your obligation would be. Until you have the complete information, then you would go in and file an amended return and fix your return and pay the correct amount.
Okay. What are some mistakes that people make when they're filing their taxes? Do you see any top mistakes across the board that people make every year?
A lot of people, this could be something as, the appropriate filing status or things like that, whether you're single or head of household, or married filing joint, or married filing separately. A lot of people get confused about that, although it's fairly straightforward. Some people miss out on credits they're entitled to, like earned income credit, which is really good for lower income people that have dependent children. So that's a good credit to have. American Opportunity Credit is generally something that people miss. So if you have, $4,000 in qualified education expenses, the potential credit for that is worth up to $2,500 for the person going to college. So that's something that people miss quite frequently. Another thing that people miss is the ability to itemize their deductions rather than take a standard deduction that the government decides. So basically how taxes work is you have income that's taxed, and there are two parts of your income that you don't have to pay tax on. One is called an exemption, which is income that you earn that you're exempt from paying taxes on. And the other thing is a deduction. You're you're allowed to deduct certain expenses. So some people choose to add up all the expenses that they're entitled to deduct, and other people take the standard deduction, which the government assigns. So it may be advantageous for you to add up your deductions rather than take the standard.
Okay, I know that there's a lot of credits that people are eligible for, and some people may have questions about who they should hire to get their taxes done. Let's take a short break, and we'll come back and finish our conversation with that. Still a lot more, so we'll talk about that as well as what to do if you get audited. Stay with us. You're watching 22 News in Focus. You're watching 22 News in Focus. We're continuing our conversation now with Andy Flaherty, an H&R Block tax specialist, and you were just talking to us about a number of credits people may not realize that they're eligible for. Also talking to us about what to do if you're late filing and need an extension. Some great information you've already offered. What are some of these life events that people may have throughout the year that may change the way they file their taxes, that may impact that?
Well, the number one life event that could change your taxes is getting married or having a child. Now, when you get married, you're combining incomes and expenses in another family. And the thing you want to take a look at is, okay, how am I doing my withholdings now? Right, because your income situation is going to be totally different. And if you're having children, you get more exemptions and potentially more tax credits. So you want to take that into consideration when you're doing your tax planning. One of the things I would recommend to people when they're getting married is to talk to their spouse about, okay, what is your income level? What is my income level? How are our finances going to combine? And what are the appropriate things we can do to withhold and plan for our tax future? Having a baby is great for tax consequences. You get a nice child tax credit on top of that.
A little tax break.
And not only that, earlier I mentioned a thing called exemptions. Income that you earn is exempt from every dependent you have gives you another exemption. So depending on your marginal tax rate, let's say you're in the 10% marginal tax bracket, one other exemption is 10% of $3,950. So that's another $300 or $400 in your pocket. So.
How about buying property, buying a house for the first time? I know in the past there have been some first-time homebuyer credits. I don't know if there are still.
I'm not aware of any current first-time homebuyer credits. That's something one of our more experienced tax professionals may be able to advise people on. One of the things I would say is you want to take a look at your mortgage interest statement and things like that, because now that you're a homeowner, you definitely want to get into itemizing your deductions, and mortgage interest and real estate taxes is one of the main advantages of owning a home. You're allowed to increase your deductions, which is going to lower your tax liability. So it kind of helps you make payments towards your home and things like that when you're taking those mortgage deductions.
Right, and as we hear about some of these changes, so it makes me wonder, when do you transfer from filing your own taxes, because filing your own taxes can be pretty simple up to a certain point, and then when do you sort of cross that threshold into it being a little bit more complicated and you may want to talk to somebody?
Being a tax professional, I always think it's to your advantage to come and talk to a tax professional, not necessarily because of the complexity level of your return, but of the advice that we can give you while you're sitting down talking to me one-on-one. When you're doing it on home on your computer and things like that, nobody's telling you, hey, let's take a look at your withholdings. Hey, let's take a look at how these life changes are going to affect your tax life. And that is one of the advantages of sitting one-on-one with a tax professional. We're experts in that. We know how to interpret all the rules and what the specific jargon is and what the definition of certain terms are. When you're at home and you got to look up what the definition of a term is, then try to figure out on a worksheet how that works onto your tax return, it further complicates things. our jobs as tax professionals to make it look easy and seamless, and we can do it in a conversational manner. So my answer to that question is it's always better to talk to a tax professional, especially in planning for the future.
Right, and another thing is if you do ever miss a credit, I know that there is a certain point you can go back some 3 years or so.
Sure, you can always go back 3 years to correct or add any information to your tax returns. So that's always a good thing, and quite frequently at H&R Block we have a thing called the second look, where we'll analyze your last 3 years worth of tax returns, and quite frequently we find people credits or more money they could have got back on their returns, and then we file amendments for them, and they're able to take advantage of our expertise that way.
Okay, so what questions, because some people will file on their own, just because, financially it might be a little bit cheaper or just more convenient for them. But if somebody does choose to go to a professional, what sort of questions should you be asking? What sort of information should you be presenting so that you find the professional who's reliable, I guess, so to speak, if you do get audited? And, how can you find out that you're going to someone who's going to be there to help you out?
Well, the first thing you could do is check the Better Business Bureau and see how the company as a whole is rated. There's a lot of alternatives in private companies that do tax return. There's a couple major national chains, and then there's CPAs and various other people that do taxes professionally. You could ask around to your friends. At H&R Block, we have a nice program called Tax Pro Finder that has the bios of all our tax pros on there and what their level of expertise is. So that's what I would recommend people is go to our website, use Tax Pro Finder, find somebody with the appropriate level of experience to handle your specific tax situation.
Do some research and see if this tax preparer has a history and a good history at that.
Right. It's like one of the things that there's no substitute for is institutional knowledge.
Right.
Right. As a professional tax preparers, in my office alone, there's over 200 years of experience. Right.
Yeah, you want somebody who knows the laws inside and out. That's for sure.
Exactly. There's no substitute for 200 years of experience in preparing taxes. I have tax professionals that do 300 to 400 returns a year.
Right.
Right. So they're very experienced. They have the knowledge base, and inside our company, we also have the knowledge base.
Sometimes it is nice to have someone to fall back on when you do get audited. And I want to talk about what are some of the red flags that can make you a target of becoming audited?
Really things that look out of whack and things that don't make a lot of sense. Without getting into a lot of specifics, let's say you decide that you want to file as head of household, but your income level is very low. Part of the requirements for filing as head of household is you have to provide 50% of the support of the household in order for you to get that. So if your salary is $8,000 to $10,000 and you're trying to file as head of household, that's going to send off a red flag to say, okay, with that income level, how could you provide 50% of the support? Other things are taking expenses or credit that are out of whack with the normally accepted practices. Let's say I make $20,000 a year and I claim on my itemized deductions that I give $15,000 in charitable contributions. Somebody's going to look at that and go, that doesn't make a lot of sense. So things that are out of whack with the percentages that the average person takes could send a red flag to be audited. The truth of the matter is audit is a word that scares everybody. They're like, oh, I'm being audited. Most of the audits that you see right now are just what we call paper audits in the office. Right? So H&R Block is one of the few retail tax companies that are open year-round. So we see these things all the time. And what people do is they'll come in from a letter, either from Massachusetts DOR or from the IRS, and the letter basically says, hey, we noticed you took these deductions or took these types of credits. We'd like some additional information on why you did that. Or, hey, I noticed you had a cancellation of debt that you didn't report. Could you report that now, or is that information accurate? So we see these letters all the time. That's what we call a paper audit, and basically we look at the letter, we interpret the letter, we go, okay, Massachusetts DOR is just asking for, proof that your child lived with you that you said you took. So that's mostly what audits are. Very few people get like this hard audit where the
yeah. So to protect yourself, how long should you keep your documentation? Say that you itemized your expenses or contributed to a charity and you kept those receipts. How long should you hang on to that stuff? Because it can really take up space.
It varies. My advice to people, I say keep it forever.
Okay.
Some people will say 7 years. Some people will say 5. If you want a good rule of thumb, 7 to 10 years worth of your tax returns and all the receipts and everything should be kept somewhere.
Keep them in a box up in the
Right,
attic, just have
right.
them
Because,
somewhere.
if you owe the IRS money, they can go back to day one. If they owe you money, they're only going to do the last 3 years worth.
That sounds fair. Yeah.
So the idea is keep good records. And I tell all my clients, I'm like keep this forever.
Right.
Right.
Now, you and I are talking pretty late in the tax
We
season,
are.
but I know that we hear all the time it's so early to file early. I mean, it's so important to file early. Talk to me about the changing dynamic of identity theft and why it is so important to file your taxes early.
Okay. Well, one of the things is there's a difference between regular identity theft and a new up-and-coming trend called tax identity theft. Regular identity theft is when somebody opens a credit line using your information. They borrow money, they buy a house, they lease a car, they do something like that. Tax identity theft is somebody getting your Social Security number and some of your information and filing a fraudulent tax return in your name. That can be nightmarish, and usually you don't find out about it till well after the fact. So that's why we encourage people to file as early as possible, because the people stealing your tax identity, the second the IRS is accepting returns, they're in there trying to file a fraudulent return under your name. And there's a couple steps you can take to protect that. One is trying to get yourself what's called an IPPIN, which is an identity theft protection number issued by the IRS. So that's one of the things you can do. H&R Block has just issued a new product that we call Tax Identity Shield that's new to the market, and it doesn't really protect your tax return this year, it protects the one for the following year. And what we do is we attempt to get people the identity theft protection number from the IRS, and some people qualify for that and some people don't. The other thing we do is we work with Experian, and they'll give you a risk assessment. They go through their Experian system, and they'll send you a report in January and say, this is where we think you're at risk for tax identity theft, and here are some steps you can take. Additionally, we have trained specialists in what we call restoration support. So if somebody steals your tax identity, it's going to take 6 to 18 months to straighten that out and get you back the money that you deserve. And it requires you to file a number of reports and follow up with the IRS and with the police and with all the reporting agencies like you do in a regular identity theft. So it is important to file early, and I recommend purchasing the additional tax identity shield that H&R Block offers.
And we're down to 1 minute, so for the people who are hearing this, how can you best prepare all year so that you can file early?
The best thing is good record keeping. Depends on your sources of income, how your income is coming in. For the majority of people, they have W-2 jobs. They're going to get either a 1095A or what's called a 1099-HC for their health care information. They may receive information on interest income or a report that they had a taxable state tax refund the year before. The idea is just when the important tax documents come in, put them in a file, keep them separate, know why you need them, and when it's time to prepare your taxes, you'll be ready.
Okay, very good. Andy Flaherty, H&R Block Tax Specialist. Thank you so much for coming on and
for
talking to
having
us. Good record keeping. Hang on to that paperwork. Ask good questions. Thank you so much. Some
Thank
great
you.
advice you've offered us today. And we'll have the last word for you after the break. Stay with us. You're watching 22 News in Focus. You're watching 22 News in Focus. April is Financial Literacy Month, which is why we've just spent the past hour talking about your money and what you could do to be in better financial shape. We talked about paying down those credit cards, building up your savings and retirement accounts, as well as getting your taxes filed on time and how you can be better prepared for next year. We hope you heard something today that you can use to improve your finances. That's our program for today. We want to thank all of our guests for joining us. Thanks to you at home for watching. And if you've missed any of it, you can watch it in full on our website at wwlp.com. From all of us here at 22 News, we wish you a wonderful Sunday. Take care.